Hi, welcome to Euclid Network TV. Can you introduce yourself for us?
Yes, hi. My name is Karl Richter. I'm Chief Executive of EngagedX. We're effectively a social enterprise that's building market infrastructure for social impact investing. And recently we published a landmark data set on social impact investing data in the UK. And what we were able to do is for the first time show what the risk and return profile for social impact investing looks like. So we looked at 12 years worth of data, and we focused initially now on the financial returns and really wanted to see what sort of financial returns are possible, what is the risk related to social investing, and what are the chances of investors either losing their money or getting their money back. And what was really interesting is to see that there was a very positive trend over the 12 years, an improving trend. That's really good. What we also saw was that the amount of risk or the default rate or capital loss was very similar, very comparable to other markets. So in the UK, there's what's known as the Enterprise Guarantee Scheme, which supports SMEs if they're struggling to access loans. And it was really interesting that the amount of the default rate on social investments is exactly the same as the default rate on that scheme. So from a pure risk perspective, investing in social enterprises is no more risky or no less risky than investing in any other SME.
Nice.
Which is very good news. On the other side, we saw that the financial returns were a little bit lower than what might be expected according to, say, market rate returns or according to risk-adjusted return benchmarks. And what we've seen is that the pricing of capital, so the interest rate charged on loans, for example, was being driven by what is affordable for the organisations, as opposed to matching the risk profile of those organisations. So it's the interest rate is often a lot lower than if they'd gone to a mainstream institution. So what that means is, for the investors, although the losses weren't more than in the mainstream, they didn't have the high-end returns to compensate for those losses. So what we saw was basically a market where it's broken even, or investors have been able to preserve their capital, and on an annualized basis we saw a slightly negative 0.77% loss annualized. So effectively it's 100% preserving capital, which certainly is a good news story, because a lot of people have been very skeptical about social investment and said that really a lot of these organisations should have been receiving grants instead of social investment, i.e. repayable capital. And what this data evidences is that it is viable, it is feasible for social enterprise and social innovators to take on repayable capital and do so in a sustainable way.
Great news for the community.
Which is excellent. It's interesting that that data came out a month ago in the UK, and a similar data set has just been released today by the Global Impact Investing Network and Cambridge Associates. It focuses on global impact investing, which is so there's been an element of slightly different investments incorporated in that data sample. So in the UK, by social investments, and in the sample that we looked at, we looked really at the high risk end of the market, what's sometimes referred to as social first, where the motivation was all around, or primarily around, getting the money deployed and seeing it working to support the activity of social enterprises.
Yeah.
And it was less so about making a financial return or a market rate financial return. And it was really more about experimenting with this as a type of way of funding social innovators and enterprises, and it's proven that it's been very successful. With the data set that came out today by the GIN and Cambridge Associates, it was very much looking at impact investing in terms of international investment, and often linked to the development or international development and aid agenda. Where it's been internationally invested, for example, in Africa or Asia or South America, other emerging markets, and their summary was to say that the financial returns were very good, and comparable with market rate returns available in the open market, in the mainstream. So what we're seeing is that and there's an assumption here that data set probably relates to what has been referred to as the finance first end of the spectrum.
Yeah.
And there's a little bit of work to be done now, first of all, to look at comparable data sets over similar geographies, and also to look at better segmentation so that we know we're comparing like for like, and to be able to, for example, bundle all of those that are more impact first and be able to compare those together, and then separately be able to compare all those investments that are finance first. And I think that starts to outline some of the work that needs to happen, and I think it's a very exciting chapter because there's a lot bubbling away, there's a lot happening globally, and the next phase will be about integrating that.
Yeah, definitely a strong opportunity within Europe and also for the community, so exciting times ahead. All right, thanks very much for talking with us.
You're very welcome.
Cheers.